90% of us don't have the vision to see like 20-30 years ahead that what kind of wealth one can create through equities. So this is most important, whether it is equity mutual fund investing for a long term or direct stocks investing. If you are going wrong in any of the three, trust me, it is going to be very difficult creating wealth out of equities. You know the pattern of society. Where do rich people invest? So wealthiest 1% people put their money in. If you just open up a Fortune 500 list of companies for Forbes 1000 richest people in the world, almost 99% people, 98% of the people would be business owners, right? They're not celebrities, they're not scientists, doctors, sports people. They're all business owners. I really liked the wonderful interview by Basant Maheshwari where he shared, you don't become rich by investing in properties. You first become rich and then you buy properties. You first become rich and then you buy gold. And how do you become rich? You become rich mostly by your businesses. Okay? It's very difficult to become rich by being salaried person. Very difficult. There are only handful of people who gets a lot of ESOPs and hence they become super rich like a business owner. So simple mantras for asset allocation. Please remember this. This is very, very important. So now it brings me to the next very powerful point in equities, which is a very, very powerful mantra from the book, uh, 100 to 1 in the stock market. To make money in stocks or equities, you must have three things. And this is what Ramdev Agrawal also shares many times through his different speeches. The first is the vision to see. 90% of us don't have the vision to see like 20-30 years ahead that what kind of wealth one can create through equities. So you need the vision to see, the courage to buy, particularly when no one else is buying, and finally the patience to hold. Patience is the rarest of the three. I see a lot of people can still has the vision, not maybe 20-30 years, but at least 5-10 years. They still might go and have the courage to buy, but the patience to hold is the most important thing. And that is where 90% people find it difficult. They sell it too fast, too soon, and miss out on the complete upside story. So this is most important, whether it is equity mutual fund investing for a long term or direct stocks investing. If you are going wrong in any of the three, trust me, it is going to be very difficult creating wealth out of equities. Okay, so this is there. And the reason today, the problem why we are not able to see long term, why we have a problem with patience, right? The reason is to blame for something called ticker. The red line that you see on news channel, business news channels on the TV screen, which is flashing, that's a ticker. And that is our worst enemies, because we are seeing the price every now and then. What Warren Buffett says, I buy on the assumption that they could close the market the next day and not reopen for the 10 years. Because he doesn't buy stocks, he buy businesses. He's not an investor, he's an owner of those wonderful businesses. And he's very much likely to hold it for next 10, 20, 30, 40 years. For example, he's been holding Coca-Cola for many years, like 20, 25, 30 years. American Express, uh, Apple shares for the last 5, 7 years. And I can go on and on. So this is what Warren Buffett does. When he buys, he's not going to look at tomorrow or day after or next year, right? So the problem is the ticker, because if you bought it $100, the price in next day or 2 days later has come to 120. People think, okay, I'm making 20% quick gain, let me sell. You may make returns out of this, but you cannot create wealth by using this approach, right? I've not seen anyone creating sizable amount of wealth after 20-30 years by looking at the ticker and by buying and selling all the time, right? It doesn't work. So the problem is the ticker. Imagine if this ticker was put on your house every day. You bought your house at 10 lakhs. Today the house is quoting 11 lakhs, 12 lakhs. You could have never stayed in that house, because houses don't have tickers. You don't calculate the prices every day. You remain invested for 10, 15, 20 years, and naturally you make a lot of money through that investment in that property, in that land or house that you have built, right? So the problem is the ticker. Okay, and what happens with the ticker, and this is what why retail investors in India remains retail most of the time, because most retail investors, because they don't have knowledge, they would all buy cheap stocks. They would buy not very quality stocks. They would buy the stocks which are like penny stocks, which are trading at 1, 2, 5, 10 rupees. They, again, the challenge is they want to all become rich quickly. So, more so in the companies where the corporate governance is less, where they, the stock prices are very volatile, retail investors will get in, and that is where mutual funds or foreign investors will stay away from. If you have to make long-term wealth from stock market, it has to be in great companies. You buying for a long term, and you have to have patience, right?
You can achieve your luxury car, dream home, retirement, and all your other financial goals without taking a loan. How? Through mutual fund investing. Hi, I'm Gajendra Kothari, founder of Etika Wealth Private Limited, and I've been investing in the mutual funds for the past 15 years. I'm here on Upsurge.club with my mutual fund course to help you achieve financial freedom. In this course, I will teach you everything about mutual funds, how they work, their different types, how to analyze the mutual fund scheme, and how to select the best fund for yourself. You'll also learn how to build your mutual fund portfolio through examples. So, enroll in this free course today and start your wealth creation journey with mutual funds.
Now, this is a very, very powerful study which was done, which is what is the ownership society, the pattern of society, where do rich people invest? So let's go to the right, left side. So percentage of total assets and liabilities held by wealthiest 1% people in America and the world, next 9% and bottom 90%. So where do wealthiest 1% put their money? So wealthiest 1% people put their money in business equities, which means they become rich by businesses. Bill Gates is rich because of Microsoft. Steve Jobs was rich because of Apple. Warren Buffett is rich because of Berkshire Hathaway. Jeff Bezos is rich because of Amazon. Elon Musk is rich because of Tesla. So they become multi-billionaire because of the business equities they own. The second biggest place where they put their money is financial securities. So they invest in other financial securities like mutual funds, stocks, 55%. And this is the third is stocks and mutual fund. This could be private equity, venture capital, and other things. So if you see, rich people, they invest broadly their money here. And now let us see, where do bottom 90% of the people put their money, right? First of all, they don't have a lot of money and they're in debt. And this is like bottom 90%. They're always in debt all their lives, some or other debt. Then they want to buy the principal residence. This is where bulk of their life savings goes, bulk of their wealth goes. And then they want to have pension accounts where they want to get a regular pension income, whatever. And then they do fixed deposits. They are the one who don't want to play risky. They don't want to invest in stock markets or mutual funds for the long term, because A, they don't have knowledge, right? And B, because they don't have enough money or time period to hold for this, because it requires a lot of time period to create wealth in equities, but you get the maximum amount of delta there. Here it is not there. So that is, and this is unfortunately in India, this is in the world, this is across the same place, you'll find the same pattern. A lot of this has to do with literacy, I believe, right? Because these are not taught in schools, colleges. We end up making mistake and we don't buy this. But remember this, this is quite powerful. Again, this study was done. The top 10% own the majority of financial assets in this country. This is about US, okay? And the top 0.1% owns a ridiculous amount of that wealth, right? And if you just open up a Fortune 500 list of companies for Forbes 1000 richest people in the world, almost 99% people, 98% of the people would be business owners, right? They're not celebrities, they're not scientists, doctors, sports people. They're all business owners. And top 10% of the wealth owns 87% of stocks, right? Wealthy, these owns 80. So this is top 1% of the people. Okay, this is 99. This is another 1%, and this is 90 to 99. All this put together, top 10% people own 87% of the stocks, and bottom 90% owns 56% of real estate, right? So bottom people go for real estate, the top and wealthy goes for businesses. That's the major difference between rich and the poor from long-term wealth creation point of view. Okay, this is very, very difficult to digest by most people, because in our country, we've been taught that properties create the highest this wealth. This is what people assume. I really liked a wonderful interview by Basant Maheshwari where he shared that you don't become rich by investing in properties. You first become rich and then you buy properties. You first become rich and then you buy gold. And how do you become rich? You become rich mostly by your businesses. Okay, it's very difficult to become rich by being salaried person. Very difficult. There are only handful of people who gets a lot of ESOPs and hence they become super rich like a business owner. But and of course this culture started 10, 15, 20 years back, and going in the coming years, of course we'll see a lot more people from startups, from other industries where you're a salaried person and you're making a lot of wealth through ESOPs. But otherwise, through just a paycheck on a monthly basis, it's very, very difficult to become super rich, right? This is classic example from the book Rich Dad Poor Dad. Very, very important, very, very fundamental to understand that how poor people, middle class and rich have their own balance sheets or profit and loss. So poor people, first of all, they have a job, they get some income, and everything goes through expenditure. They hardly have any savings left. And because they don't have savings, they're not able to buy any asset. That is why poor people don't have balance sheets. Correct? Then this is the most interesting part, middle class. So middle class also people have jobs, they work somewhere, they get some income. Based on this income, and they think this income is going to come for lifetime, why not cash on this, right? And they buy a huge asset thinking that is an asset, but actually it's a liability, because until you pay all the EMIs for the next 20 years, suppose I'm talking about house, okay, you pay all the EMI, it is not your asset, it is still a liability. The bank can possess it at any point of time. So they create a liability for next 10, 15, 20 years, and from their expenses, and the EMI becomes their expenditure. So every time they are in this cycle, and that is why most of the time you're not able to see that asset. Only after 20, 30 years when their liabilities free, then this will become assets, but it will take a long while. What does rich people do? This is quite interesting. First of all, as you can see, they have no jobs. They don't do jobs. They create assets, they create businesses, and from those businesses, right, for the rest of the life they get income. So they don't have liabilities. I mean, income will then fund their expenditure, the monthly income what they get. This is a classic way Rich Dad Poor Dad showed the difference between rich people think, how rich people think, how rich dad think, how the poor dad think. Okay, so many people again don't understand this, don't get this funda right, and that is why they're not able to create wealth. Now you have been wondering that I've been talking about that why businesses create wealth. The reason why businesses create wealth is the stock markets go up only for one reason in the long term, only one fundamental reason, that the profits of these companies also goes up. If the profits of these companies starts going down, stock market will not be able to go up, right? So the only fundamental truth in long term returns from stock market is it is earnings driven, which means if the companies, as a basket of companies, if they fail to go up in terms of profits, as a business owner, if I'm investing in these 50 companies, if these 50 companies is not making money for me as a basket and I'm not increasing my profits year after year, then stock prices will not go up. It has to fall down. So it is, and most of the time the CAGR, the compounded returns of the stock market, is exactly in line with what has been the earnings growth over the last 10, 15, 20 years. In the short term, this ratio might not match, but in the long term, like 5, 7, 10 years, it all comes back to the same level, right? So what moves the market? Very, very interesting way to see. In the short term, it is a sentiment that moves the market, right? Russia Ukraine war, elections, and earnings is only this. As time passes, as you go towards long term, sentiment becomes lower and earnings become the maximum force to drive stock markets. Always remember this, whether it is India, China, anywhere in the world, this one fundamental was true 500 years back, it's true today, and it is going to be true 500 years down the line. Finally, the companies has to make profits. If you don't make profits, stock prices can't go sustainably higher for the long term, right? So when you buy stocks, when you invest in equities, two things: price is what you pay, value is what you get. Price is same for all, but value you might see different, I might see different. we're all paying the same price, right? So suppose we paid this price, but today the value is much higher than the price I paid. Okay, so the price that I paid for this particular value was much lower. So the price which I paid was this. If I value that company will keep going up, next year my thing becomes even more valuable. It becomes even more valuable after 2 years, because the price I pay remains the same cost price for me, but every year, because the value goes up of that investment, I make a lot more money, right? So if you're paying low price for a certain value, so suppose you think the company currently is trading at 100 bucks, okay, but in your mind you think that the value of the company is actually 200. So you are paying the price of 100, value is 200, right? Market is not factoring in this. You're buying this. Next year you think that the value will go to 300, right? So you're making lot more money because you paid 100, the value is 300. So time becomes your friend. If you have paid less price today for the value you think in the future, but if you overpaid the price, overpaid, the value was this, you paid this much, the next year of course value might catch up, and it might catch up, but it will take many years for your value to be unlocked, and time becomes your enemy. So that is why you can't overpay in an investment. If you overpay, whether you invest when the markets are high, you invest in a stock when it is too high, it will take many years, many years for you to break even. I remember classically Infosys in India and Microsoft in US in 2000. If somebody bought Infosys and Microsoft at the highest level, right? It took 15 years for the stock prices to, for your investment in those companies to break even. 15 years. They didn't go anywhere. Though the earnings have gone up quite substantially over those 15 years period, but because we paid such a high price at the peak of the cycle, we didn't make anything. So everything is good at a price. You have to understand what is the price that you are paying and what is the value you are getting. That's very important. Okay. And look at this. This is a classic comparison of all the asset classes. It is Indian equities, US equities in INR, all in the same currency, gold, real estate, and debt. I usually don't look at 1, 3, 5 year returns because these are pretty small short term returns. Generally go for 10 years, 15 years, 20 years. So in 10 years, Indian equities has given around 14% per annum compounded returns. US equities has given 16.9%, gold has given 11.5, real estate as a basket has given 4.7, and debt 7.2. Now this is 10 year. Let's look 20 years. Indian equities has given 15% return per annum for the last 20 years. US equities is 14%, gold is 13%, real estate is 8%, and debt is 7.5. So in the long term, as you can see here, Indian equities has beaten all asset classes. In 10 and 15 years, US equities has beaten Indian equities also. So, US being the largest market in the world, it might be a good idea to diversify if you want to play within equities, but you want to diversify. You don't want to put everything in Indian equities. US equities can be good bet. And this is number of times your money has been multiplied. So if you invested 1 lakh, okay, 20 years back in equities, today it has become 19 lakhs. In US equity, it has become 14 lakhs, 12 lakhs, 5 lakhs, 4 lakhs in all other asset classes. So this is per annum return. This is the number of times your money has multiplied over these years. Finally, this brings me to what asset class for what time period. So simple mantras for asset allocation. Please remember this. This is very important. If you want to create wealth, you have to be in equities in the long term. Gold is for ornaments to me. Generally, if you want to buy gold as an ornament, that is a great asset class. From a buy and hold long term, maybe you can have 10-15% of your allocation in gold. The best time to buy is gold when it is going through its worst phase. Okay. And when again prices are through the roof, you might want to reallocate that money to other asset class. Same thing goes with equity, same thing goes with any other asset class. Insurance to me is for protection, right? Only for risk cover. It's not an investment. Fixed income to me is for regular income, or if you are looking for a guaranteed income, right? FDs, debt funds for short term, for regular income, or as a guaranteed kind of a place. Real estate is either for a home or office. Again, if you want to buy real estate as an investment, buy it when it is going through its downturn. When nobody's buying, then buy it. So these are the simple rules, makes the entire process of investing easier. But you know what people do in reality? People choose real estate for regular income, insurance for tax saving, gold for creating wealth, and equities for entertainment. Right? Makes investing messy. This is what we see in social media, what we see people around us doing, because their asset allocation whole funda has gone wrong, right? And remember, if you want to create wealth in stock markets are like a cardiogram. If they stay steady, they will die. They die, right? So if you have to create wealth in equities, it has to be highly volatile, because the more volatile the markets are, the more returns, the more potential the returns for an investor, right? And as I said, finally, asset allocation is the key. Where you put your money broadly, in which asset class, at what time. If you're buying any asset class when they were cheap and selling when they were high, is when you will make maximum money. Within that asset class, the stock selection or fund selection, mutual fund selection, this stock versus that stock is hardly 4%, and market timing is hardly 2%. Unfortunately, today we spend all the time in the world in identifying these two. We go wrong completely here. So that is why it is very important for us to focus on asset allocation, right? I have generally done that. I always look big macro picture, which asset class is performing very badly right now, right? And then I go and buy whatever is available in that asset class. So in March 2020, small cap equities were the worst performing. I bought that, as a subsector. So equities itself were trading at a much lower valuation. Small cap were trading at even lower valuations, right? So you have to keep checking this. You have to sell and buy only at the extreme points, in your opinion. You might be wrong. You might not be able to catch exactly the bottom and the top. That's okay. Even if you miss 10%, 15% gains, that's quite okay. So the sphere of market rotations, right? This is very important. How to identify which asset class is expensive or cheap. This is where you can identify. Winner keeps changing every year. Remember this. Okay, there is no permanent winner, right? Allocation at asset class level or market cap curves is important. And let me show you what do I mean. So if you see here, this is how asset classes has performed over the years, 2009 to 2024 September. This was there. So Nifty 500 is the best performing asset class in this year. Then comes US equities. Gold has been average, silver has been average, FD is bottom, and currency bottom. So you have currencies, inflation, FD, gold, silver, US equities, Indian equities, broadly all these asset classes, right? So generally remember the asset classes which have done well, like in 2018, 19, 20, gold did well, second best. That's why gold has to do little bad. And again in 2022, gold did, because it was bad here, it did amazing. Then right now it is somewhere middle. So either it can stay middle, or if it goes up here, the next year it has to go down. That is one way. Okay. The other way to look at is in last 5 years, which asset class gave the best return. So Nifty 500 has given the best return, S&P 500 is given second best. So now I'll be little more worried in these two asset classes, because they have really done well in the recent past, right? So most likely either your FDs can be better, okay, or if this crashes next year, silver, gold can do better. So gold, of course, has done 15%, Nifty has done 22%. So gold can still do better, going forward, because it is all market cyclical. So this is 5 years, 10 years, 15 years. This is one way to look at it. The second way to look at it is within equities. Okay, last 5 years, 10 years, 15 years, micro caps have done extremely well. The reason why 15 years also is done well, because the last 5 years is crazy returns, and this pulls up the 10-year and 15-year return. Again, I'll be very worried with micro caps right now, and of course I'll be going more strong on large caps right now, okay, because large caps in the last 5 years, 10 years had not performed. So as a contra bet, right, asset allocation, I would like to focus here, because markets are cycles has to change at some point of time. Okay, this again I might go wrong, but this is how I look at this as a framework. Then within sectors also you can do the same thing. You have pharma, you have metal, whichever sectors has gone up. So auto has gone up very well, very well, very well for the last, because auto didn't do very well this time, this time, this time, and this time. And this was the time when I started putting money in auto sector. And now my auto sector fund has given amazing returns, right? The same thing I did with PSUs. PSUs didn't do well for 10 years. And now in the last 5 years, PSUs as a basket has done quite well. Same thing goes with infra. Infra did not do well. Look at what happened to infra in 2019 to 20. This was infra, this was infra, this was infra, this was infra, this was infra. It was either at the middle, bottom. Look at the bottom. Look at the bottom. All infra. So what has to happen in 2020, now infra is doing well. Infra is doing well, and infra did very well. Is done very well. Of course, now last 5 years infra has done very well. It looks risky again now from the short term point of view. This is one way to identify sectors, market caps, okay, asset classes, because this is called contra investing. You're going because winners keep rotating, cycles keep changing, and that is why it is important to identify. And this is to do with the styles, momentum style, quality style, value style. So in the last 3-4 years, momentum and value has done very well in the last 3 and 4 years. So most likely now quality or low volatility should do well in the next cycle, hopefully. Generally these data points don't go wrong, as in you may have to have more patience. You know, 3 years, suppose you thought value has done well for 2 years, now you think value is not going to do well. Value still did well, it still did well. This can test your patience. Okay, so if you bought quality here, or if you bought your quality here, right, I'll say hold it for longer term, it will play out. But when it plays out, it gives you all the returns, right? So this is there. And finally, this is what asset allocation chart Mint prepares, live Mint newspaper. I follow this. Comes every year at the end of calendar year. So I also look at this. 2 years back to back, small caps didn't do well, right? Next 2 years, it did massively well. And I knew I had invested a lot of money then. So I got all this upside. Then I knew next year it is not going to do well. Okay. And the same thing happened. It was worst. Because it was worst, it again bounced back very well. So always remember, asset allocation changes all the time, and this is how you can make money. But if you want to make money in stock markets, okay, through direct investing in equities, guys, you need three things. In fact, four. The first, do you have the interest to put money in direct stocks? You need to have a deep interest, right? Second, do you have time to research the balance sheet, profit and loss, fundamentals of the companies? And finally, do you have that capacity to do the research? In the sense, do you have that knowledge? Have you done these kind of courses like CFA, right, or equity market research analyst courses? If you don't have any of the three, you will not make money in equities, right? So interest, time, knowledge, and after that, the fourth thing is luck. You may have done all three very rightly. Luck will test you. Okay. If you don't have time for if you don't have any of the three, then go to a professional fund manager like a mutual fund or a PMS or whosoever whose full-time job is doing this. Because if you're going to dabble on your own by picking stocks on your own, you'll go horribly wrong in the long term. You are just trying your luck. You are playing these bets only on your conviction. It is not rewarded in the long term, right? And many people go for PMSs. Generally, I believe mutual funds are a better vehicle for a common person, even for ultra high net worth, because it's very tightly regulated by SEBIs, and we're going to discuss a lot more on mutual funds. But right now I'm showing this to you because many people are having this confusion. If I have to go to professional, should I put my money in PMS? And the minimum amount that you have to put in PMS is 50 lakhs. Minimum amount that you have to put in mutual fund is like 500 rupees, right? But many people don't want to put money in PMSs, the rich people, because they think, oh no, 5,000, 10,000, even an average Joe can invest. I'm different, right? I want something more private. I want something. So while not all PMSs are bad, there are few ones which have very different approach. But my experience tells me over the last 20 years that 90-95% of the PMSs are not worthy to invest. right? You will not end up beating mutual funds, or you'll not end up beating index also. Yet you're paying much higher cost in terms of the charges. They are far more expensive. The management fees are not capped, in the sense they, they can charge you much higher fees. The brokerage costs again can be expenditure, can be higher expenditure. But few things which I find that why mutual funds beat is, first thing is, every time in PMS, the fund manager buys and sells stocks on your behalf, you pay taxes. Mutual funds, only when you buy and sell, you pay taxes. Okay, which means your fund manager can keep buying and selling for 10 years. You don't have to pay tax. But in PMS, you have to pay tax. Of course, now the short term, long term has become 12.5. Okay, and short term has become 20%. So all the more it is very important that you should do less of churning. Okay, right? In dividend income, there's no tax implication for the investor, because it's all tax free in mutual fund at the trust level. Here you pay the maximum marginal rate of taxes, right? And finally, mutual fund may you get tax benefit for the expense ratio. Expense ratio is adjusted in the NAV, but in PMS, you pay the difference between short term and long term, and then you pay the fees separately, right? So for all these reasons, personally, I believe that, most people, mutual funds can be a far better tax efficient structure than PMSs, right? If you ask me, even in my case, 95% of my money is in mutual funds, and 5% of the uh, funds is there in few PMSs, just to try and compare that over a long term, which can be better. Maybe after 3 5 years, if I see a substantial difference between my PMS returns and mutual fund, if PMS is given much larger returns, then of course I may have a more tilt towards PMS. But right now, as things stand, I think mutual funds are a better way for most common people, for most of you, to go through and invest there.